Money FM 89.3, the best of the afternoon update.
Money FM 89.3. Now, in 2025, real estate investment activity across the Asia-Pacific region is poised for a shift. With the interest rate cut cycle underway in most markets, investors are gearing up for an increase in activity over the next 12 months. And that optimism is reflected in CBRE's 2025 Asia-Pacific Investor Intentions Survey released recently, which uncovered an improvement in buying intentions across most markets in Asia-Pacific this year. Over half of respondents in the survey indicated their preference to buy more real estate in 2025. Without further ado, let's find out more from Greg Hyland, Head of Capital Markets APAC at CBRE. Welcome, Greg.
Thanks, Lindley. Pleasure to be here.
Now, real estate investment activity in most markets are forecast to increase through this year. What are we seeing across the board, Greg? Which markets will see most gains across the region?
I think what we're expecting to see this year is over the last 18 months, a lot of markets have experienced increases in interest rates. And if we look at sort of developed Asia, which in our view is Japan, South Korea, Singapore and Australia, it's probably been South Korea and Australia that have had the most impact by rising interest rates. And in those particular markets, rates have stabilised, and in some instances like South Korea, they've begun to fall. And that's where we really start to see investor confidence return to the marketplace more broadly. And that's beginning to see, an increase in transaction activity. If we move to developing Asia, and that's largely a story dominated by India, it's always had high inflation and very high rates. So it's a market where, again, investors that are seeking outsized exposure for a developing economy, there's a lot of interest there at the moment.
Getting into details, what's the overall sentiment? We're talking more than 5% increase?
I think we're forecasting between a 5 and 10% increase across the Asia-Pacific markets. And we believe that that's based on what we're seeing now, particularly from the end of last year and going into Q1. We're pretty confident that those numbers will be met.
Okay. And you were mentioning certain markets earlier. The survey shows that varying levels of transaction activity across different markets. Could you talk more about the factors that are driving these differences, and how should investors navigate these disparities?
I think the factors that we're really seeing is the improving economic performance in a lot of these locations. So economic growth is starting to accelerate. I think secondly, some of the real estate fundamentals as we come out of a slowdown remain extremely robust. So generally speaking, supply demand remained relatively favourable for investors, probably with the exception of China, which is going through a fairly significant restructuring at the moment where they have material oversupply. So I think the economic position overlaid with the underlying fundamentals. And interestingly, what we have seen is creating new supply or new buildings has become extremely expensive. Coming out of COVID, building costs have really become very expensive. So the economic rents or the economic viability of building new buildings is very challenging. So that's going to limit the supply side going forward. So I think investors really believe that the cash flows that assets are going to be able to generate into the future are quite robust.
Okay, Greg, let's talk about asset classes. In that summary of the survey, it said that offices and data centers have seen a rise in investor interest this year. Can you share insights into what makes these asset classes particularly attractive?
I'll start with data centers. I mean, our world is becoming digitized. So there's an explosive need for digital storage, and that's really been led by data centers. So we've seen a very broad and significant shift from investors to looking to get exposure to digital assets, and we think that trend continues. Office is probably coming from the other end. There was perception that office struggled because of COVID and the work from home phenomenon. That started to unwind, and you've seen that across a lot of markets, particularly I think driven in the West where they probably had more impact. So you look at some of the mandates that are coming out of the US and other locations now where there's return to work. I think the Asian markets probably had a lesser impact on work from home. But broadly speaking, that trend's starting to dissipate, and we feel that the demand for offices is looking positive.
Any data on Singapore at all?
I think in terms of Singapore, I don't have the exact data figures, but anecdotally, the clients that we deal with in the private sector, they're largely insisting on at least a 3 or 4 day work week. And in some instances, I'm aware of companies that are insisting on 5 days a week. And understand that the public sector is probably lagging in terms of the mandates for return to work. But broadly speaking, we're seeing the trend that employers are really wanting their employees back in the office.
What about alternatives? What about healthcare assets and other classes that might be interesting or appealing for investors?
Yeah, we have seen healthcare emerge, and I think that's largely driven by some of the demographics in our region. So we look at aging societies, particularly in developing markets, and where we sit at the moment, China, Japan, Korea. To a degree, if you look at Singapore, we all are aging, and the demand and need for healthcare is only going to increase. And I think investors see that as a driver for creating investment opportunities for them.
Okay, I want to talk about cross-border real estate investment. What are we seeing in that survey?
I think what we're seeing, and again, we're sitting in Singapore. Singapore is probably one of the largest exporters of real estate investment capital globally. And I think that's, Singapore's largely driven because it's a small place and has finite resources. And it's a huge, I suppose, creator of investment capital globally. What we have started to see, though, is groups, so intra-Asia, so people that are from Asia are looking outside their home markets. And I think we've started to see a real return from groups from the Middle East, from Europe, and also from North America, in particular Canada, which has been largely quite slow over the last 12 to 18 months. We are starting to see a rebound from them.
I just have one question regarding the survey in terms of when it was done. I think it was done last year in November and December. Things have changed much since then?
I think the underlying trends have probably remained intact. I mean, one of the big risks that investors identified is political risk. And obviously, we've all read in the paper and witnessed the change in administration in the US. And so I think some of the potential risks around tariffs, trade barriers, and the politics and how that may impact the flow of capital is potentially a risk on the horizon. Again, looking at South Korea, having sort of some of the political issues there as well. So I think some of our investors see some political risk as short term. Others see some of the issues that are more long term. But as we sit today, I would say that investors are still on balance are optimistic about this year.
Okay. And coming back to investor interest, we were talking about the rate of increase earlier. And again, I refer back to the survey, which said that investors in Singapore and Hong Kong, alongside landlords with significant AUM in Australia and Korea, displayed the biggest change in net buying intentions in 2025. Greg, why is this so?
I think the primary factor has been a lot of those investors, particularly Australia and South Korea, have been going through a period where interest rates have increased dramatically. So that really dampened enthusiasm. Hong Kong has its own issues. Interest rates there, they adopt or follow US dollar monetary policy, so it's quite restrictive. And then Singapore is, again, probably in between those two, that it's slightly more cautious. What we have started to see, I think the biggest change is people's confidence in being able to price cost of capital. They feel that asset prices now reflect fair value. In some instances, they may have overcorrected, so they feel it's a good time to be entering into the marketplace. So it's probably an element of doing nothing for a considerable period of time, waiting to see what's happened, and now having a degree of confidence to actually move.
Okay, we haven't talked much about investor type in terms of buying intentions. Any thoughts on that?
We see a really wide range of investors. During, I suppose, periods of upheaval, we tend to see more private investors are able to take a view and move more quickly than perhaps institutional investors. So I would say in the most immediate past, we were dealing a lot with private, ultra-high net worth individuals. Now we're starting to see a shift towards more institutional capital as they have become comfortable with where cost of capital is pricing. And by that, I mean sovereign wealth funds, insurance companies, pension groups, endowments. So it's really quite interesting to see that individuals tend to be able to take a position and move quicker. Some of the institutions take a little longer to move on an opportunity.
Okay. As you mentioned, there are more institutions going into investment in terms of real estate. And most central banks in this region have either commenced or are about to begin the interest rate cutting cycle. What are you seeing going forward in the next 6 months, perhaps? Will anything change dynamically?
Look, I think any change in interest rate policy or cut in interest rates does help asset prices. So that's a given. But what we have started to see is people believe that the pace of and the potential scope of interest rate falls is actually going to be relatively modest. So that's really resulted in groups looking and drilling down through what the fundamentals of the underlying investment are. So I think it's a realization that, yes, it's definitely a tailwind, but picking the right market, the right asset class is probably going to drive a bigger percentage of returns.
Okay. And sustainability remains a priority for investors, with green buildings ranked above retrofitting in 2025. So how are ESG considerations influencing investment decisions, and how do you see this trend evolving?
We look at it three ways. The movement towards sustainability has been driven by government policy. That's first and foremost. I think secondly, the investor community has also been giving commitments to their underlying LPs around investing in assets that are sustainable. And then you look at the third side of the triangle, it's really the end users. So when you look at major occupiers globally, they've generally given commitments around sustainability. So when you put all those three together, you really do create sort of demand and a push towards moving into, sustainable product. I think when we look at sustainable buildings, because a lot of the technology is still relatively modern and new, so inherently that tends to be installed in newer developed product. And when we look at newer developed product, it typically it's built to the best in class, not just sustainability, but other features of the building. And those can combine generally attract a rental premium or premium to older product. So it's really going to be interesting. I think the question is going to be, new buildings are always going to be at the forefront of technology, and sustainability is just one part of that. It's what's going to happen with buildings that perhaps older in nature don't have the same technology. How are they going to compete for occupiers into the future?
And which markets lead this region in terms of green building adoption?
I think most countries have. I mean, Singapore, if we sit here, they have a building rating system. It's a requirement where for new product to meet certain standards. If you look at sort of Australia, it has a system called Neighbours, where it has an energy rating system, a building code, and some of the major occupiers can only occupy certain standards of buildings. So I would say it's probably more the developed countries have led it. But interestingly, I think when you look at places that are developing, most of their buildings are all brand new. So they have a really good opportunity to leapfrog a lot of developed countries that have older inventory and as they add new inventory. So I would say at the moment it's been led by the developed countries, but I believe that the developing countries have a real opportunity to create new cities that are leading edge.
Yeah, I think with most of the region trying to achieve the net zero emissions by 2050, I'm sure most investors would be looking to integrate the ESG criteria into their investment decisions. We've talked a lot about sentiment, investor intentions, but ultimately we have to make sure that risks are being considered. So what challenges should investors look into in achieving their target returns in 2025, and how can they mitigate these risks?
There's a couple of things. Probably front and center is the politics. So and there is certain parts of our region have tensions and whether they escalate. So that's probably the one that we all don't hope escalates. I think the other thing is the concept of relative value. Capital is quite fungible and it can generally go to anywhere in the world where it wants to invest. So your parts of Asia Pacific need to remain competitive from a tax, employment flexibility, opportunity that really set the stage for economic growth. And we really don't have any demand for commercial facilities unless we're generating positive economic growth. So I think probably in the short term, the politics and in the medium term is to make sure we have policy settings in our parts of the world that are attractive on a global perspective are probably the two risks that I would look at.
Okay. And in terms of the survey, what was the top risks or challenges that investors have picked out?
I think politics did come out as one. And I think that was at the time when US election was on and there was a lot of rhetoric between US and China relations. So I think from our perspective, or from what came back from the survey, the politics was definitely one. I think also monetary policy is still a risk. In certain areas, inflation remains sticky. And, there is some talk that in certain places interest rates might actually increase. So that's probably a risk as well that that we need to take a look at or consider.
Okay, thank you so much for your insights, Greg. Greg Hyland, Head of Capital Markets APAC at CBRE.
Thank you.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.